Hey everyone, welcome back to All Things Home Loans, Credit, and Real Estate. I am your host, Deb, the Mortgage Queen. So let's start learning. Hey, it's the Mortgage Queen. We're going to talk about underwriting today. And I have a love-hate relationship with underwriters. You've definitely probably heard this out of my mouth before. But let's dive in. We're going to go behind the curtain with underwriting. And it's a place where your income gets questioned, your deposits get interrogated, and your credit is, your credit is judged more than a reality TV show. It is what it is. That's what it is. So, let's talk about the first one. What underwriting actually is. Underwriting is basically our person that sits behind the scenes and makes sure that we have verified all the risk of the loan. Make sure that the documents that we've provided are actually validated, and making sure that all of the guidelines that we have to have, the guidelines we have to abide by, basically, we have to make sure that those are all met. They're a complete disinterested third party. I can't really say disinterested third party because they're not really a third party. They're a part of our group, but they have no relationship with the borrower. They haven't had the conversations and for lack of better words, the sob story of what's gone on with the borrower. And sometimes it's not really a sob story, but some of those harder files to get done, there's a sob story behind it. But they have no personal connection to the person that they're looking at the big picture of. So they're just checking everything out from a whole different set of eyes. And it's our job as a loan officer seat to package up the file and make sure that everything that we have given the underwriter to see is, first of all, stuff we need in the file. We don't need to give them more stuff than they need. That's kind of annoying for them to sift through. And then also we just got to make sure that we've got all of our I's dotted and our T's crossed. And that's really us working together. I've worked in a handful of offices. I guess I've worked with a handful of underwriters that were absolutely unworkable. So I can understand why the underwriters have a bad reputation sometimes, because in the big picture of it, they're not supposed to be putting their emotions into it, or I feel like I just don't like this file, or hey, I just don't like that. No, if it meets the guideline, we give them the loan. If the risk factors line up okay, we give them the loan. It's not that I don't feel good about it. And I have definitely had a couple of underwriters that I'm like, you don't get to underwrite that way. You don't get to underwrite that way. I'm sorry, the guideline is XYZ. You don't have the ability to give me the guideline that says why I can't do it, but I can give you the reason why I can. Therefore, approve the loan. And I'm grateful for the underwriter team that we have right now, because they are get on the phone. Okay, this is what I'm dealing with. Like, oh yeah, that'll be okay. Just document XYZ. Okay, sounds great. So some underwriters are known to be a little bit more picky, and I think the reason why is when underwriters they have like a code with their name. They're like a, can't really say a license number, but their certification number that follows that file. And in the event that the loan gets sold to the third party company who's going to be doing the servicing, if that file goes sideways and maybe the people stop making the mortgage payment, the current servicer is actually going to go back through that file and do a forensic audit and say, who else can we blame here? Who else can we say was the one that was at fault, so that we can kick it off our servicing portfolio and kick it back to the originating investor, which is basically us. Which at that point, it goes against the underwriter. Like, hey underwriter, why didn't you question this? Hey underwriter, why didn't you do that? And really, it not very often does it come back clear to the loan officer. So we don't even know some of that stuff's gone on. So when you think about it, the underwriter is the one that really has the option or the opportunity of getting their hands slapped. And their job is to check to make sure there's no loan fraud. Have we crossed all the bridges that we need to document everything full circle? So let's dive into a couple things. The automated underwriting systems came out a long time ago, and they basically analyze everything. We put all of the data into the loan file, electronic loan file, and then we click a button and it looks at credit, income, assets, and all of the information that's in that loan file. It gives us a risk factor on that. We're either approved or refer, or we just are a caution we can't do the loan. And each conventional and FHA loan, VA and USDA type program, they have different classifications within that. FHA does the manual underwrite. You have the ability to do manual underwrite. So if it comes back with refer, we're okay with that. We just have to meet other things. We have to make sure we've met other obligations. On the conventional side, if it comes back as an approve eligible, great, we're rocking and rolling. But the big thing is we have to make sure that the information that we put in the system, we can actually document. If I show I have $30,000 in my bank account, I have to be able to provide the document that I do have $30,000 in my bank account. So just because you put the numbers in and get the approval doesn't mean you just automatically get the approval. You have to paper trail everything else that goes into it. It goes through your maximum debt to income ratio. How high of a debt to income ratio can you handle? And some of that comes into a risk factor. If you've got a bunch of money in a 401k, you've got a bunch of money in your savings account, sometimes the system will be okay with a higher debt to income ratio because it's like, hey, if something happens to this guy and he loses his job, he's got a bunch of money in his bank account that he can fall back on. So we're okay with having that debt ratio tick up just a little bit higher. It goes through whether or not you're a W-2 wage earner or a self-employed person. A W-2 wage earner, which I just think is kind of interesting. It's less of a risk factor to be a W-2 wage earner, which is, in my mind, kind of a silly risk layer, because if you've got a person that is self-employed and have been for, say, 2+ years, 3+ years, even 20 years, I would think that a self-employed person would be more motivated to keep their job the way that it is. They want their business to succeed. They want their business to grow. They want their business to be profitable. Where a W-2 wage earner, they could be going to work every day, clocking in, clocking out, doing their job 100%, maybe even 150%, and the idiot management or the idiot ownership above wasn't fiscally responsible, and they end up closing their doors. So I think, I do understand the self-employment being a little bit of a risk factor, but let's think about this in a way that a self-employed person has nothing to gain by not being fiscally responsible. They have everything to lose. But anyways, that's a little bit of a side note. It looks at whether or not we have a line item for overtime, commissions, bonuses, things like that, and calls out and says, hey, make sure you have the proper years and waiting period on having all of those things. Variable hours come into play, whether or not I worked 30 hours during the winter months, and then I work 45 hours during the summer months. Those are going to be considered variable hours. As long as you're working consistently 40 hours plus, it's okay if it's 40 hours this week and 48 next week and 52 the next week and then 40. It's just that bare minimum hours have got to be 40. Rental income, if you own properties, if there is a section on your loan application that shows that you have a rental property and you're receiving income off of that, it's going to say, hey, I see you have rental income. Did you make sure you have these checks and balances in place? And did the tax return show that you have income? Did you just barely turn that into a rental? Here's the steps to be required for that part of it. So that is all looked at in that automated system. And it's kind of cool because it's an AI thing, and AI has been out like full force over the last, I would dare say, year. Everybody under the sun is using AI, but us mortgage people, we were actually using it many, 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 many years ago, just at a very, very scaled down version. And the underwriter will look at the credit analysis. Credit is interesting because everybody feels differently about credit. You've got people who are just so scared to death to make late payments. That would be me. I'm so horrified of something going wrong on my credit report to the point that I have ate some people for lunch. Like, for instance, I sold a home a couple of years ago and I never got the final invoice on the power bill. And I kept watching for it. I reached out to the power company one time and I said, hey, I haven't seen this. Oh, we haven't closed the books out. And then I forgot about it. I was like on it for the first couple of weeks and then I just totally forgot about it. Never saw anything, never received anything. And then I got notified that they were sending that final power bill to the collection agency. Oh, I lit up. I was so mad. Anyways, I got that all paid. It was taken care of. It never went on my credit report. But there's a lot of people who just think, well, I never got the bill. It's not my problem. Well, I'm sorry. Adulting means you do your due diligence. If you owed the money, follow through and make sure you got it taken care of. It was really like, be an adult. Hello, that's what you want to do. So it'll look at how we've made our payments on time. Do we have credit depth? Do we have things on our credit to show that we do have the ability to actually make payments? How much of our credit cards are we using in comparison to how much we can take out? If we have 4 credit cards that we can take out $1,000, are they all maxed out, or are they staying at lower numbers? That's looked at. Do I have any charge-off, collections, judgments, bankruptcies, foreclosures? Am I a co-signer with somebody? Am I an authorized user? A lot of times parents will throw their kids on as authorized users on their credit cards to help them establish credit. There's a point that doesn't help your credit anymore, so you've got to be watching for that too. And then also, if you have 5 lines of credit on your credit report and all 5 of them are authorized user, that isn't really a credit line that belongs to you. Your parents or whoever it is that you're an authorized user on, they're the ones that are making those payments in most cases if you're just an authorized user. So it's not really showing that you have the ability to pay credit. So be careful on that authorization to just use that credit card. Any new trade lines, a whole bunch of new trade lines. What inquiries popped up on credit? They're looking at that. And the reason, like on the inquiry part of it, is did you get 2 new lines of credit and we don't have it on the credit report, but we show these inquiries and we've got a debt to income ratio that's really tight anyways? We've got to make sure that those things are all taken into consideration. So credit is really scrutinized. And disputed accounts, making sure that you don't have just disputed accounts. And that's a big misunderstanding. People just think, wow, that's not my credit line, I'm just going to dispute it. Or, hey, I don't want to pay it, I think I can fight it, I'm just going to dispute it. In certain ways, that's a problem, because that disputed account actually gets pulled out of the credit score. And so the automated system can't see that it exists. You'd think that it'd be smarter than that, but it doesn't. It's not. It's basically saying, hey, if there's any disputed accounts, you got to do this with it. And that's all going to be dealt with too. The next week, we're going to go down like the asset side. What do we have for assets listed in our accounts? Did we put $30,000 in a 401k? Do we have the paperwork that shows that we have $30,000 in our 401k? Where did the funds that are in our bank account come from? Do we have transfers in and out of other bank accounts? We've got to have all those bank statements that go along with that. Do we have large deposits that are a higher percentage than we're allowed on based off of our gross income that are just random deposits? We've got to make sure we know where those come from. Gift funds, earnest money clearing, retirement access, having, like, say the 401k is part of our reserves for us to be able to qualify. Do we have access to that? And I'll use that as an example. In the state of Idaho, we have PERSI, which basically there's 4 things that you have to have happen in order to access your PERSI, the section of the PERSI for your retirement. You either have to die, you have to become disabled, you have to quit your job, and what's the 4th one? I never can remember the 4th one. Anyways, but the 4 things are, you don't want them to happen. Like, we don't really want people to die if they owe money on a loan. We don't really want them to become disabled because maybe they can't really pay their loan back. And we don't necessarily want them quitting their job unless we can prove that they have another job. So the things with those PERSIs, they're not, like, even though the PERSI says, hey, there's $80,000 sitting in this PERSI, I can't get that out. If I'm a fully vested government or school teacher type employee, I can't get that out until I've had those other things happen, which are not a positive thing when it comes to our loan. If we have a bank statement because we're self-employed or we want to run a little side business and it's in a business bank account, what happens if we pull all the money out of the bank account of that business? Does it stop the business from being able to function? We have to be able to document that we have the ability to take those funds and not have it be a detriment to our business operations. Cash flow inconsistencies. So in self-employment, we're showing that we have $20,000 a month in income because you're a super good self-employment person, because that's the example I'm using. You have $20,000 worth of self-employment income. We have 3 months of bank statements that are from your business, and the deposits are only $8,000. It seems a little inconsistent. And so we have to explain that. Like, okay, well, maybe these 3 months are November, December, and January, and we're a landscaping company. So unless in our area it snowed a lot, your landscaping stuff isn't really going on in December and January. It's more of a June, July, August type thing, and you're just pummeled with deposits at that point, but it goes really, really low in the December, January, February, November time. So those inconsistencies, we have to deal with them. From there, we go into the property. What type of property do we have? Is there anything around the property that's an issue? Railroad tracks, power lines, huge industrial things, commercial buildings, those kind of things that pull residential feel out, cause a little bit of an issue with marketability. gravel pits. I can't really think much more than that. Really, the industrial commercial side of it is a big, big, big scope, and that covers pretty much everything. The appraiser is tasked with taking plenty of pictures around so that they can have the ability to show the underwriter what's really going on around it. I remember years and years and years ago, we had an appraiser that did an appraisal. I knew the area really well. There was a gravel pit and a huge transformer station all right there by the house. And it was back before some of the appraisal laws came in, and he purposely took angles of pictures so the underwriter didn't see it. And naive, I was very naive at the time, and I called the appraiser, and that was when we were allowed to talk to appraisers, say, hey, appraiser, what's up with this? He's like, oh yeah, it's fine, I just took those pictures so we didn't have to worry about it. And I'm like, okay, sounds good. No idea what happened. I'm assuming the loan performed and everything was fine. I had a really beautiful home once. It was like half a mile from a gravel pit. I didn't mind the dump trucks and things that went by it. I really didn't mind, just because most of the time dump trucks are going pretty slow, and so it was a pretty slow traffic type situation. Even though they were a little bit louder, most of them were pretty respectful. So some people just don't care about things like that. But anyways, that appraiser is responsible for making sure that they are the eyeballs for the underwriter, and the underwriter is going to scrutinize that appraisal. It also goes through an automated system to make sure that it meets a certain score, and that score is going to say whether or not the value is supported. Like, hey, yeah, we know it came in at value on the purchase price, that the person that's buying this home says, yep, this is what I'm willing to buy for it. The appraisal came in there, but there's a score model behind it that basically says, yeah, this is pretty risky. You might want to have a second appraiser just double check that this value is really there. That score model goes into place too. It's also an AI type system. It's all going through the appraisal pretty quickly. Something to note, this is kind of an interesting thing that people don't realize. There is a guideline, ANSI guidelines, that basically say over 50% of the house has to have a ceiling height of 7 feet or taller. The habitable area of the home has to be 7 foot or taller. In our area, there's very few homes that are less than 7 foot. There just really aren't very many of them. But there are obviously some areas that have more of this issue than not. But in order for the square footage to be counted, the ANSI requirements are you have to have 50% or more of the home be at least 7 foot or taller. And that is a definite not known rule out there, and people need to be very aware of that when they're buying a house. I'm only 5'4", so to be in a 7 foot tall ceiling doesn't bother me. But I have a really good friend that's over 6 foot tall, and you're over 6 foot, you're just a couple inches from the ceiling at 7 foot. So it's not probably best to just completely just not pay attention to those ceiling heights, and the ANSI requirements require it. Appraisers, in most cases, don't measure the ceiling height. It's kind of an unfortunate thing. So it's definitely out there more than we realize, but appraisers have not done their job with that, and so it's gonna bite some people in the butt the wrong direction, because some appraisers are just like completely discredited. Yeah, it's not that big of a deal, or didn't even know it existed because they're not keeping up with their CE. That's kind of interesting. But safety things. The concept of sloping away from the house, if there's rainwater coming off and the water's coming down really a lot, is the water sloping away from the house, or is it going back towards the foundation? That's something the appraiser is going to call out. Are there 3+ step down, and if somebody fell off that, they'd probably get hurt? Maybe we need some handrails. My favorite is chipped and peeling paint. We have chipped and peeling paint in this area. If the home was built in the time frame that there could be lead-based paint, even if the whole thing has been totally repainted, if there's a chance that there's chipped and peeling paint, we have to get that taken care of too. Appraiser's going to call that out. Sad thing about it is somewhere along the line, somebody let their kids eat paint chips and sued somebody because that's what's happened, and now we all have to reap the benefits of making sure that no chipped and peeling paint exists, and no bare wood. Obviously wood is only good for so long out in the weather. Paint is there as a weather barrier, so we also want the wood of the home to be withheld against the weather as well. So that'll be called out if there's any bare wood. Making sure that the zoning's right. Is our highest and best use of the home going to be residential? That's what we're doing a loan for, is on a residential loan. Is our highest and best use residential? condos, take some time to look up the Florida condo that fell. That's where some of the condo rules came into play. And I would absolutely tell you on a condo side of things, we don't have a lot of condos in our area. Most of them are townhomes, those ones that are connected together. But condo restrictions are pretty healthy because of what went on in that Florida home, and they really just hunkered down. Condos are just a different beast, and it's kind of an unknown fact that condos are scrutinized a lot differently than townhomes or duplexes, other homes that are attached together. Making sure that the homes have comparables. Hey, I'm going to buy this house for $350,000. Are there other homes with like images of my home that I'm going to buy at $350,000? We just barely learned about manufactured homes that can be duplex. Manufactured home duplexes. I don't think there is even one in our area that's ever sold. So until those become a little bit more popular, we're not going to be able to do manufactured home duplexes. We got to have comparables for them. A single family residence type property like a stick-built home, the duplex is not going to compare to a manufactured home. They're two totally different products. So they're not going to be able to compare. So having comparables that are like property, homes that have accessory dwellings compared to other homes that don't have accessory dwellings. Also kind of a newer thing to our area, having accessory dwellings. And those appraisals have to have like properties to say, yep, these comparables exist. Yep, this home does meet the requirements or does have enough comparables for the value that's there. Flipping rules. This is really a fun thing too. So there's a little bit of a beef I have with real estate agents who have opportunities to buy homes, and they take the opportunity to fix them up, and they take the profit and the flipping. I I have a hard time with that because I feel like we have a lot of our little first time home buyers that would love the opportunity to get into some of those lower priced homes, grab a renovation loan behind it, and take the opportunity to be able to turn that into their own little first time home. But you have a lot of real estate agents that just nab those up, which, I mean, it's fine. They're in the industry. It is what it is. I just think it's kind of unfortunate. It's a little bit of a disservice, I think, to the environment that you're in. Just, I don't know, give the first time home buyers an opportunity. I think there's nothing wrong with that. Also on appraisals, there are classification ratings. They go from C1 to C6. And basically the appraiser says, hey, this is a C1, that's great. The home's in really, really good shape. If it's a C6, it probably should be condemned. I mean, that's kind of the best description. And we can't lend on a C6. We have to get some renovation financing behind it if we're going to get into a C6. Those homes that get classified, those upper numbers, kind of sketchy. The collateral is not the greatest, and so the underwriter definitely forces us to do just a little bit more. What's going on with the market? There's a section in the appraisal that basically says we're in a steady market. Sure, maybe inventory is 6 months, but we're still staying steady, or we're in a declining market. Underwriters will scrutinize that just a little bit more to make sure if we are in a declining market, are we doing 100% financing? Do the borrowers have any down payment, or are we doing down payment assistance? They're going to scrutinize a declining market differently if we're a steady market or accelerating or increasing. I'm trying to think of anything else. Property, you have to remember, when it comes to the appraisal, the property is probably the biggest piece of it we have to make sure. Of course, the borrower paying the money back is important. But at the end of the day, if the borrower does not pay the money back, the lending institution still has the collateral. So the appraisal is a bigger piece because we have to have something that if the investor has to take the home back, it's a home that they can market back out into the industry and be able to get the home sold and recover the loss that they have. So appraisals are really scrutinized. I think it's unfortunate sometimes appraisers don't realize the importance that they have with a couple of things. Making sure that they don't feel the pressure of just coming in with value because they don't want the wrath of what a real estate agent's going to do if the value comes down. Also being a little bit concerned to call things out that maybe are I can't really say they're borderline safety things, maybe sometimes taken a little extreme on the safety part of things. There's some appraisers that are just so relaxed and lax that it causes more issue. Like, you really should have called that out. But for the most part, I think we have pretty decent appraisers that stay level ground. But that doesn't mean that the underwriter is not going to do their own kind of audit and make sure that Like, hey, here's the appraisal. These pictures kind of seem a little bit weird, like how they've taken them. They're going to jump on Google Earth and they're just going to make sure there wasn't something missed. There's definitely so many avenues for the underwriters to do a double check to make sure we really are okay. And they do it. They do it. They make sure that we are okay when it comes to that collateral, because that is technically what's going to come back for the servicer if the borrower doesn't choose to pay the money back. We go into like the overall picture of everything. You know, we've talked about income, assets, and debt ratios and all of those things that go into this file. But then as a whole, it's what kind of risk factors do we have here? Is the home solid? Is the borrower solid? Does the borrower have reserves? Does the borrower debt ratio look okay? And all those risk factors line up differently. So, okay, we have a really solid borrower, scores are great. They've got some decent reserves, not really the most wonderful. Property's like, kind of sketchy, but we have proof that they have like incredible payment history on rent. They've owned a home before and incredible payment history on that mortgage. Really, there's just like all these little things like, okay, this one's good, this one's bad, this one's good, this one's bad. And it's definitely going to help. The risk factors are definitely how many bad, how many good, and which one outweighs what, to make sure that they actually have a solid deal that we are going to make sure that the loan gets paid back. Now let's talk about conditions. When the underwriter goes through and reviews everything, us as a loan officer, we put everything in and say, okay, here's what we've got for assets, income, credit, la 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 la, all that stuff. And they come back and say, hey, we've got everything we need, but hey, we're missing one pay stub, or hey, can you get one more month of bank statements, or hey, these are greater than 120 days, we need to have something updated. And that's what those conditions are. The underwriter gives us the conditions and says, yep, I'll do this loan, but I need these things in order for us to get to the closing table. And that's when conditions come in. The thing that gets frustrating to clients is when it continues to get more and more and more. So you have to pause for just a minute and think about this. Okay, let's take bank statements, for instance. If I give a bank statement, all 4 pages, last page is blank white, but it's page 404, so I have to have it. I don't even look at it. I just hand it to the loan officer. Loan officer looks at it and says, hey, you have a negative balance 3 times this month. We can't get this to the underwriter like this without some sort of explanation. Hey, you've got 3 very just random share deposits. One's $8 grand, one's $4 grand, one's $5 grand. Where'd those come from? Hey, we have transfers from this other bank account that I don't have. That's going to say, okay, thanks for the bank statement, but now I need this. And that's where sometimes clients get frustrated because, like, oh my gosh, they just asked for one more thing, one more thing, one more thing. You're right. Except for what you gave me open the doors to the one more thing. So pause for just a minute and look at what you're giving to me. Is it going to force any questions? Pay stubs, same thing. If there's no child support on your loan application because you didn't disclose it, yet your pay stub shows a child support garnishment, when we get that pay stub, we're going to say, where's your child support order or your divorce decree? I don't pay child support. Well, you've got a garnishment. Oh, that's for back child support. Okay, well, we have to have something showing how much do you owe on it. Have you made your payments on time? Is everything good that way? So it gets frustrating from the client side, but from my seat as a loan officer, I would just say, just be patient, because it's my job to look at those documents and say, hey, I'm going to need that one more thing. Sure, I would like you as a consumer to look at that and say, I wonder if there's anything here that they're going to possibly need more of. Right, but that's not your seat. So I would just say, be more patient with, here's my bank statement. Do you need anything more? No, we're good. Everything clears. Or yeah, I do. What about this? And just be willing to produce what needs to be produced. It is really not that difficult. Just work with me. Just work with me. Don't get frustrated. So once the underwriter reviews the file initially, appraisal title, all that stuff is done, we go back and we say, hey, we need these conditions based off of everything that we've got. Here's the last pieces that we're going to have. Then the underwriter does their final review and issues us our clear to close. And the one piece that everybody doesn't understand, not everybody, I can't say everybody, a lot of people don't understand, is once you get that clear to close, you're not done. We still verify you're employed, because that is something that we have had bite us in the butt before. So we're still going to verify you're employed. And we've also got monitoring going on. If you get any new lines of or credit inquiries, we're going to be notified of it. So just chill. Just stay employed. Don't get any new lines of credit. Just keep making your mortgage payments and your monthly payments and all that stuff on time. Whether you're a purchaser or refi, just make sure you're making those payments on time. Because until that actually the loan actually funds, wire gets to the title company, and we actually record, we still have to just make sure everything is perfect. After that, we don't really have control of your life anymore. But in that window of time when you're shopping for a home, refinancing your home, going through the process of the loan application, loan approval process, underwriting, all that, that little circle of time is like, don't do anything in your life without talking to me. It's very critical. And you'll be happier if you just communicate with what you've got going on. Just because you're in the middle of the loan process doesn't mean you can't go buy a new car. You just need to converse with us. Like, hey, my debt ratio is 30%. Can I go buy this $500 a month car? Yeah, you're going to be fine if your debt ratio is only 30%, but communicate with us. Once the loan gets to a clear to close stage, there is a quality control that goes on, just making sure that there wasn't anything missed. You know, we're all machines, so we're just going through the motions of getting everything done, and sometimes underwriters miss things or addresses get a number reversed or whatever. So there is a quality control audit that goes on just to make sure that everything is perfect before we get to the closing table. And other than that, it's really this little piece I want to just talk about is, I think you'd be super, super surprised of what I can pull about you. Underwriters who don't have any communication with a client whatsoever, they have this like sixth sense. They know when borrowers are lying. They know when documents have been altered. They know when there's debt that has not been disclosed. They know when there's things that are specifically being pulled out of the file because some of the little circle doesn't go full circle. Fake documents, altered documents, redacted documents, they're all red flags and they're all findable by an underwriter. They have a whole different set of eyeballs on that file. And I'm just telling you from a very big PSA standpoint, don't commit loan fraud. Don't commit identity theft. Don't commit occupancy fraud. If you're not going to move into it, don't call it your primary residence. If you're not going to have it as an investment property, don't be taking advantage of the investment property programs that are out there. You don't have to verify income. Just do things on the above board. You just do. I don't think anybody really wants to be behind the black and white, you know, in the black and white stripes and or orange or whatever color it is. We have a way to find it out. There are reports and details behind the scenes of the things that we get to look into. Just tell us, and then we can work through there. If there are things that are a little bit of a concern, talk to us. Some things are not a concern. Some things aren't a problem, and so you might as well just talk to us and let us get it figured out. But all I can tell you is be patient. Jump in with your loan officer and realize they're on your team. First of all, loan officers don't get paid for the most part. They don't get paid unless your loan closes. And so they've got some skin in the game. They're putting a lot of time out there. And if the day of closing you just decide you don't want to buy a house, they're out all of that time of getting your loan done. So they definitely want to see that loan close. They want to see you successful. They want to make sure that you're not house poor, and they want to make sure that you are going to enjoy that new home that you bought. Or if we're looking at doing a refinance, we're actually putting you into a financial situation that you can be financially free or freer. Give you a little bit of just breathing room if you're struggling financially, and we can utilize some of your equity in your home. With that being said, we have to remember a couple things. Underwriters, they're not villains. They're what would I say? They're a seatbelt. They're a seatbelt. Not everybody loves them. Not everybody uses them. But you have to. Like, it's just like needed. Blinkers would be another thing. Not everybody loves blinkers, but you definitely should be using them. That's definitely going to keep us in the right place, not getting ran over. You know, so underwriters are definitely something that we have to have in our industry, and we want them. And there's third, fourth sets of eyes, because there are bad apples out there, and those underwriters are set up to make sure that we keep everything on the uppity up, and we can keep our industry going, because the bad apples can take our industry out. We saw it in 2008. We got to make sure that we stay on the uppity up with everything. So that being said, Mortgage Queen checking out. I appreciate you listening to this about the underwriting situation and what really goes on behind the scenes, and look forward to seeing you again.
Thanks so much for listening. I really appreciate it. So stay tuned. We are going to learn some more next time.